Thank you so much for inviting me to speak at this fantastic event on psychology. This is all about psychology. So I'm going to share with you from my experience on this very important topic. And my topic is called the trader's pendulum and how to ride it mindfully. I'm going to describe that to you. This is my book. This came out really at the end of 2015, but it's still apropos. And it's called The Trader's Pendulum, the 10 Habits of Highly Successful Traders. So I will take something from the book today, but just a little bit of background about myself. I started out on Wall Street with JP Morgan trading Forex. I was the only female British pound trader amongst the major banks. And it was a completely different market then and a completely way of doing business. We had squawk boxes. We called for prices among the major banks. Oh my gosh, it was so different to today. But today is so fantastic because the barriers to trading are totally gone and everybody can trade as long as they follow their system and they really keep their emotions in check, but we're going to go into that in detail. Now I'm the CEO of FXTradersEdge.com, which is an education company with many trading tools and an Elliott Wave focus. So everything that I do has to do with the market cycles. I'm a strong believer that the markets move in cycles and that we can trade those cycles. And at the end, I'm going to offer everybody here some free coaching with me. Okay? I'm not going to sell you anything today. Just going to offer you my time. Please read this disclaimer to yourself. Very important that you practice with a demo or paper trading account or a small live account with any new concept or strategy until you really get to know and understand the risk and reward potential. So what is the trader's pendulum? I've broken it down into 3 types of pendulums: the market pendulum, the emotional pendulum, and the financial pendulum. The market pendulum is the market swings, the trends, and the corrections. And once we get in sync with the market swings, then we know when to enter a trade, and we don't enter the trade after it's moved too far. We wait for the pullback, and if we want to go with the momentum, fine, but we know when the momentum is going to start. The emotional pendulum is I think it moves between fear and greed, and we have all the emotions in between. So keeping the emotions at bay while trading is really, really important. And if something is going on in our personal lives or something going on that day, it's really important to take note and not to let it interfere with our trading. And when I was at the bank, I mean, there were times when things happened and they were told, just take off the next couple of weeks. We don't want you trading. So there is definitely truth to that. The financial pendulum is making money and losing money. Every trader loses money, but it's important not to bet the ranch and lose your hard-earned money that you spent like all week or the last couple of weeks making on one trade. So that's really, really important. So let's start off with the emotional pendulum. So again, I think fear versus greed encompasses it all: self-doubting versus overconfident, cautious versus reckless, and organized versus disorganized. It's really important to be organized in your trading. Flexible versus stubborn. Are you going to hold on to a trade just because you think it's going to go right? No, let the market take you there. Calm versus nervous. All of these things affect our trading. So let's look at the emotional pendulum when trading the market cycles. This is the fear and greed business. Well, this is the 8-wave market cycle. We have 5 waves moving up for a trend and 3 waves moving down for the major correction. We have certainly experienced this in stocks. Like over the last couple of years, we witnessed moving up to like almost an optimistic and exuberant top, and then we had the major sell-off where at this point people are fearful, panic, discouraged, and what do? They bail. So this 8-wave market cycle occurs in every single time frame, in every single market. I'm going to show you some examples of it. So you can trade off of the weekly chart, the daily chart, the 4-hour chart, the hourly chart. And it's amazing how often this pattern occurs. And then this is the time to look to buy when it's finished and it starts to, start moving up, obviously, and not be in fear at this point. Okay, you want to almost flip flop this and be in fear up here and be in greed down here. But that takes a lot to train the brain to do that. I know that that's what I work on like every day, and I've definitely improved. I mean, over the last many, many, many years of doing this, obviously. I don't work on it every day, but I have to be aware of it every day. So up here is where we want to take profits and sell, and down here is where we want to be buying. And Warren Buffett says he's the perfect idea of a contrarian. Be fearful when others are greedy. Be greedy when others are fearful. And it takes a lot to do that. It really does. But it makes a lot of sense when you think about it. And especially since Elliott wave analysis is about, trading the emotions of traders. So when we're up here, you have like everybody going in and buying and wanting to get in because they have FOMO, fear of missing out. And that's what Elliott wave analysis is all about, monitoring the emotions of investors. So let's just take a few examples of the emotional pendulum swings. Pendulum is something that swings back and forth from one course, opinion, or condition to another pair of emotions. During my trading lifetime, I've experienced most of the emotions that traders face. And these emotions behave like a pendulum. They swing from one extreme to another unless moderated. I view extreme emotions as part of a continuum where the ideal balance is somewhere in the middle, for example, at the fulcrum of a teeter-totter. Hobby traders, I think I wrote this when I had kids. No, kidding. Hobby traders learn a lot from their fellow entrepreneurial traders, including how to moderate their emotions. So let's try and understand these pairs of emotions and how they impact a trader's bottom line in modus operandi. The first pair, fear and greed. So on the left, we have fearful, and on the right, we have greedy. And let's take two scenarios. A fear scenario is that hobby trader is struggling with taking risks, and you might be able to relate to this. You might, hopefully you will, maybe you won't. So hobby trader says, I'm afraid to take risk and cannot afford to lose my $20,000 account. I had double that amount and lost it over the last year when I was planning to trade for a living and leave my job. Now I am totally stuck and afraid to take a trade. So this is not really an exaggeration. This happens to many, many people. Greed scenario. Hobby trader had 3 winning trades in a row and decided that she would risk it all on a trade that was a sure bet. I am on such a winning streak that I can't lose. I'm increasing my position size so I can take that trip to Asia that I always wanted to take. I'm sure some of you can relate to this too. Yeah, it's really easy to do that because the emotions get the better of us. I mean, I've done this as well. Truth be told, I've done this as well. So I have to be very, very careful to monitor my emotions and stick to my risk parameters. It's often said that the markets are driven by fear and greed of the masses. People have a natural inclination to want to achieve wealth, and so will follow the herd when the market is moving up with dollar signs in their eyes. And then when that investment starts losing or the market drops, they fear losing their capital and sell so as not to take a loss. So they sell not because of their trading plan. They sell because they're just winging it. And that's not the way to make money consistently in the markets. The dynamics of fear and greed drive the market. So what are some tips to temper the emotions between fear and greed? Instead of focusing on the money, Learn to appreciate the rewards of trading. That's one idea. And trade with money you can afford to lose and manage the risk so you can accept the worst case scenario of every trade taken. Understand the risk before the trade is taken and sign off on it. You just heard Anka speaking about the 1R. 1R, that's what the risk is. 1R, 2R, whatever it is that you decide to risk. Here's another one. We'll just do one more. The doubting versus overconfident trader. So the doubter on the left, the overconfident ego maniac on the right. And here's the doubting scenario. Hobby trader is struggling with doubt. He feels shaken because his strategy or methodology is not producing the results he would like to see. Quote, I find myself closing my positions early because I'm afraid my system will lose money. I don't want to take any more losses. And then the overconfident scenario. Hobby trader became overconfident in her trading 1 week to the point of putting on trades without carefully managing the risk. Again, same scenario. This position is a sure bet. I don't need a stop loss this time. Okay, these are you can't think like this, you can't act like this, because the one time you become overconfident, you're going to lose everything that you've worked so hard for if you're treating trading like a business. And we don't want to do that. We want to be able to take our losses like we take our profits and be able to move on and do something else and not think about it all day long, and certainly not regret it at the end of the trading day. I mean, that's the worst, regretting it. And I should have, would have, could have. That's another thing. Should have done this. Okay. It is often said that market wins give us confidence and market losses add to our doubt. What the markets will do tomorrow or next week is far from certain. And without perfect information, it is quite common to feel uneasy when your money is on the line. And what happens when you practice a trading setup repeatedly only to see it fail when the market conditions change without warning? Yeah, that could be a problem. So, what are some tips to temper the emotions? Instead of trading all day, enjoy the process of learning how to trade. Understand the performance metrics of the strategy you are trading, i.e., the win-loss ratio and the size of the win versus the size of the loss. And more important than that is how you trade it. What is your win-loss ratio and your size of the win versus size of the loss? Because if you track this, then it's very easy to improve it. And if you put 10 traders in the same room trading the same exact strategy, you will get 10 different trading results. It's the same. Yeah, you absolutely will. So it's trading is a personal thing, and it is important to keep track of your own metrics, performance metrics. So this is the makeover before versus after a reality trading show. The before is living at Old Habits House as hobby trader. So we don't want to live here for very long as a hobby trader if we're really serious about our trading business. We want to evolve and learn and educate ourselves and practice our trading and keep making small improvements so that we become an entrepreneurial trader and we live at transformation villas. So this is where we want to go. And you can meet Barrett and Fred are hobby traders in the technical traders trap. So they're still living at Hobby House and they are out of shape. They don't have a business plan. They're not making money consistently. They lack discipline. So they don't have a routine that they follow every single day. They trade emotionally and they don't have a trading plan. But Steve and Stacy transformed to become entrepreneurial traders. They're in shape. They live at transformational villas. They have a business plan. They make money consistently. They trade with discipline. They have their routine. And they trade unemotionally, not all the time, but a lot of the time. And they have a clear trading plan to allow them to trade emotionally if they follow their plan to trade unemotionally. Now, it doesn't matter where you are. There are many new traders and many experienced traders that are still in the technical trader's trap, still going from one system to another system, one strategy to another strategy, trying the latest and greatest tools out there, trying the latest and greatest trading signals out there. There's just so many things that traders keep trying, and they continue to be unsuccessful. But what they don't realize is they can transform themselves by just into successful traders by just sticking with one thing and working on themselves more than working on the system. And that's what a lot of people don't realize. They think that it's really the system or the strategy that's the holy grail that's going to make them successful in trading, but it's really about working on ourselves to become successful. So what process did Steve and Stacy follow to move from hobby trader to entrepreneurial trader and ride the pendulum mindfully? Well, the first step that they did is they went through what is their why. So what is your why? Why are you trading? What are your reasons for establishing a trading business? Is it to have fun, to be part of a community, to make some money on the side? Well, that to me equals hobby trader. Or is it to reach a certain income level, to reach a certain portfolio value, to be able to purchase a vacation or retirement property? So that's more in line with entrepreneurial traders. Well, I'm going to tell you what my why is. And my why has been and is to to take care of my family, and especially my daughter. I have a daughter that has just had major surgery. She's had several challenges over the last few years. So on the one hand, that has impacted my being in the markets and making sure that I have the mental capacity to do that on a given day. It's been challenging, I've got to tell you. But really what it does for me now that she has come around and seen the brighter side to what she's been going through. She's had a major surgery, and I think she's going to take off in her life now for the first time in a very long time. She's going on her, it's beautiful. So now I find myself really focusing, and that's my why. That's my why for trading and making money, just making sure that she has what she needs for her, to live her life. And that's really important. And I'm very conscious of that every single day now when I trade. What is my why? Now, I can also tell you that I'm also putting on my vision board that I have a certain vacation, a retirement property that I want to buy. So that's also part of my why. Step 2 is defining your system. And there are 3 parts to the system. In my system: A, the analysis, which is the market map. I'm going to show you that. B is the game plan. So following a strategy, I'll show you my game plan. And C is using optimal risk reward and following a trade management system. And I'm going to show you that as well. So this is my market map. This is the 8-wave market cycle. Like I explained, this occurs in any time frame and any market, where in this case on the left it's an uptrend, and then we have the correction, and then what follows after that is we most likely move higher again. If we move higher for trend, then we will take out this previous high. If we move higher in 3 waves, it's merely a correction, and then we're just going to trade sideways for a while. This is the downtrend on the right, where we trade down in 5 waves, and then we have the 3-wave correction. And if the trend is going to continue down, we will continue and take out these lows at point T in this case. If we aren't going to continue down, if we move down in 3 waves, then we're going to have a sideways move. So this is the market map. And I say for the Wavy Tunnel Pro because that's my strategy. That's the strategy that I teach. That's strategy that my students use. And it's really based on, we do have an indicator suite, but it's based on following the market cycle. So it really shows you how when we're in trend and when we're not in trend. And I'll show you that. So this is it on the right. This is a beautiful uptrend, and you can see this is the wave. The three lines are the wave. The green line is the 12 EMA, and then the black lines, that's the tunnel. It's the 144 and 169 EMA. So I'm telling you what the components are to this. And the awesome oscillator is at the bottom. So when the wave is separating from the tunnel, this is a gorgeous, gorgeous, gorgeous uptrend. And we try to stay in trend and gauge our trades based off of this. Okay, gorgeous uptrend. At the beginning of the uptrend, if we look at the left, when the market first kicks off and then retraces and then takes out the top of the wave one, this could be the start of a nice move up. And wave threes are usually very strong, and very rarely do we have, usually very strong and easy to get into during a wave three. And then we have the wave four correction, and then the wave five top, and then we have a deeper, much deeper pullback. And you can see this deeper pullback on the right when we have the A down into the wave, the B coming back out again, but not making a new high, and then the C wave down to the tunnel. And this is just a beautiful, beautiful setup to sell with the momentum down, and then to look to buy once we've finished this correction, once we turn around and start to move higher. We also look for divergence over here in the awesome oscillator to give us a sense that the market is running out of steam, and that maybe we don't want to be so excited to be long up here anymore. So the game plan, follow a strategy. That's B. Discretionary and systematic traders have systems and game plans. Successful companies have winning formulas, systems, execute that formula or system consistently. So it's important to develop your own game plan or system for your trading style and temperament. Very, very important to do that, because if you have a system and you follow it, you can track it, and you can track it, and then you can make small improvements. I can't believe I'm presenting during FOMC, and the press conference is going to be in about 5 minutes. But anyway, this is the wavy tunnel setup, and trade number one is after we've made an initial move higher, and the retracement trade number one would be when we take out these highs for being involved in the wave three, because that's a pretty strong uptrend. Trade number two is buying for the wave four pullback into the wave after we've had a strong uptrend. And again, you want to see bullish candles forming before you take your trade. You just don't want to take it in case it can go lower. And then trade number three would be to sell for this nice move down into the tunnel, and trade number four is to buy at the end of the C. Now, are you going to do all of these trades? No, you're not going to do all these trades. Everybody has a different trading personality, and you're going to decide what trade fits your trading personality, and that's what you're going to stick with, and that's what you're going to practice. But I'm just showing you a model for how all markets unfold. Now, this is an ideal setup. So I've trained myself, when I see something like this, I can tell, well, this is the ideal market map. If it's not ideal, it means that the wave is going to be chopping around the tunnel, and price will be chopping up and down and up and down. And that's kind of market that I don't want to be involved in until we start to trend again. So this is ingrained in me. I know what this setup means, and I know how to trade some of these setups, like the price to wave, and then the fill the gap trade, looking for the end of the wave C. But I'm going to show you that. So these are old examples, unfortunately. I see that this is an old example, so sorry about that. I meant to replace them. But this is the weekly SPY, and again, we had the 5 waves up and the 3 waves coming down, and this was a beautiful buy. So I just want to show you that we can see the market map in the markets. The market map is on the right, and this is the perfect setup. And what happened at this level? Price moved higher. This is the same SPX 500 on the MT4 platform. So this is a Forex trading platform. We have in our system, we have a purple arrow at the top, and then we have a gray at the end of this ABC move, and that's our signal to look for a buying opportunity. There are other things that go into it, but that's how we have that's how we delineate the market cycles. These are called swing markers. So we have our Royal up here and our Noble down here. And this is actually one of the setups that our scanner looks for on stocks. I'm going to show you that. It's fantastic because you see a whole bunch of setups like this, and you know what to do down here. Here's another one. This is the euro. This is the weekly, but this is a sideways market. But what you can do when you have a sideways market in between here is we have the large swing markers that begin and end the moves. So even though on the weekly it's sideways, you can always find a trend within from one swing move to the next. And I had some traders that actually trade these big swing moves, okay, which is incredible. You don't have to get the entire swing move, but if you catch a portion of the swing move, that's good enough. Now, I mentioned that the 8-wave market cycle on the right shows up in different time frames. So this is, imagine, look in the red box. This is the hourly. So just look at this piece. This piece here, we have a nice trend move up, and then we have the correction down below this tunnel. Doesn't this look very familiar to the 8-wave market cycle? Absolutely. And this is on an hourly chart. So this tells you that most likely, because we have a beautiful 3-wave move down, most likely this is the end and we're going to start to head higher, which we do. But look at this chop. It's just so choppy. This is the hourly chart. But this is the 8-wave market cycle on the hourly chart. We don't know what's going to happen to the right side. This is, this would be the right side of the chart. And then you can make the decision, okay, have your way of getting into a trade once you see this setup. Understand and exploit your unique trading personality. What trading style do you prefer? A lot of traders starting out don't really know what their trading personality really is. I think they have a sense of it, but there are some traders that, because they have full-time jobs, they need to take long-term positions, and they monitor their positions maybe once a week or every night, whatever. So these are the long-term position takers, and they're really monitoring their positions and tracking their positions. I like to think of it as once a month, where you really, have you might look at your trades like every day or once a week, but you're really looking at it in terms of performance metrics once a month. Then you have your medium-term swing or micro trend traders that are trading on the, let's say, the daily or the 4-hour charts, and they'd be monitoring their positions once a week, might take a couple of trades during the week. And then you have your short-term momentum or day traders that are trading every single day, and it doesn't have to be all day. It can be a couple of hours a day. But when you decide what kind of a trader you are, that will you'll see that whether you're short term or medium term or long term, you can make the same P&L. Okay, you're just making smaller amounts for your short term momentum or day trading, and you're making bigger profits for your long term positions. But you can, at the end of the month, you can make the same amount of P&L. But with your short-term momentum or day, you're tracking it every single day. With your medium-term swing, you're tracking it once a week. And with your long-term positions, you're tracking it once a month. Very, very important to track your trades. Now, a lot of traders want to start out with short-term momentum or day because they want to learn about the market. So that's, that's a good thing to do, to take a lot of trades to learn about the markets. But also I find that some traders, when they're first starting out, I don't know if it's a function of first starting out or just trading personality. It's probably just trading personality, not being patient, not having a lot of patience. So yeah, would be happier taking shorter term trades. So it's really up to the individual. Okay. Um, I do both of these. I would say that I take swing trades and I also take short-term momentum or day trades. So I fall into these two categories right now. So trending versus sideways markets. Let's learn a little bit about the market cycles. So we mentioned that the position takers would look at the bigger time frame. So that would be the red line. These are the long-term traders. And then the medium-term swing traders would maybe look at the blue line. Maybe this is a 4-hour chart. And the short-term traders would be subject to these short-term swings. So maybe this is a 15-minute chart or a 5-minute chart. So just know that if you're trading on a smaller time frame chart, the 5-minute chart, you need to know what's happening on the bigger time frames by doing a top-down approach, because otherwise you're going to get stuck in this, and you're not going to realize that this could be the start of a nice uptrend. Not that it really matters when you're day trading, but it does, because you don't want to go against the trend. Even with your day trading, it's much easier to go with the trend with your day trading. Much easier, because the trend moves are going to happen much quicker than the corrections. If you're trading a correction by selling, you're going to miss the bigger move. And you can see that with all of these swings. So when you superimpose 3 different time frames on each other like this, so let's say the red is the daily, the blue is the 4-hour, and the green is the hourly. Let's just say the hourly or the 15-minute. To get into a trend, you want to be buying after the pullback once it starts to move higher. So this green, you're going to be buying down here. You're going to be buying down here. You're going to be buying down here. And that's how the swing moves work. So an uptrend is higher highs and higher lows. If the long-term trend is up, the medium-term and the short-term trends will cycle through the trends and corrections, giving multiple buy signals along the way. So it's not that the market is bearish over here just because it's going down. It's just having a correction. And that's what we have to recognize, that that's just part of the market cycle, the way it trades, that we have corrections before the next trend move higher. Okay. This is the weekly NASDAQ. This is an old chart, but look at the 8-wave market cycle to the right and look at the awesome oscillator divergence leading into this top. And then we have this beautiful move down. Now, this is a weekly chart. So this is an example where, okay, you say, well, we found a bottom here. So we're going to trade the swing moves higher. And here's a correction, but you're going to be trading the swing moves higher. This is an hourly downtrend. Notice how the wave separates from the tunnel, and then look what happens. We have divergence, and then the market turns around, and just look at how the directional bias changes once the wave starts to move up. Once we have our fill the gap trade. The fill the gap is just when the gap is filled between the wave and the tunnel. Okay, that's this move here. And then the wave turns higher, and this starts the uptrend again, the trend in the opposite direction. But this is the 8-wave market cycle in the downtrend. Okay, this is an uptrend to the right. Now I want to share with you there are some tools that we've developed to get you into buying at the end of the wave. See here, our tools also show you when the purple arrow shows up, when the gray arrows show up, and then you can go and do your own analysis. Especially if you're trading stocks, you're trading a whole universe of stocks. There's so many things to look at. This gives you an easy way to focus in, or us an easy way, me an easy way to focus in on the stocks that I want to be involved with. And once the market has started to move up, then I won't look, if I'm interested in certain markets, if let's say, I don't know, a bunch of stocks are moving up, then I would look at the hourly chart for this setup, because I know that I'm not going to pick the bottom on the weekly anymore. They've already started to move higher. So I would scan for the hourlies and see where we are and see this setup, and then look to buy to get into the trend. So I took this yesterday. This is the weekly. I actually looked at I was going to show you the weekly and the daily and the hourly, but let's just keep it simple. I'm just going to show you the weekly. This is our scanner on TradeStation. And the important columns here are the ready and the signal. So the ready is, these are weekly candles. So the ready is when we get the gray dot or the gray arrow. We have this on a few different platforms. So the ready is when we get the gray dot. And then the signal is when price goes above the 12 EMA. That's our signal. We can sort by signal, which I've done here, or we can sort by ready. And if we sort by ready, we're going to we have the potential to get in earlier. And I'm going to show you what I mean with that. So I just took the first few stocks here. This is called the breakout 4 trade. And yeah, so let's start with the weekly on the left. We have the gray dot. So you can see the 8-wave market cycle. We have the purple dot on top. This is where the FOMO sets in, fear of missing out. And then once we start to trade below this area here, the wave, we have the potential to move down here. And usually we trade lower. So look what happens. Elliott wave corrections happen in 3 waves. So we have a nice wave A, followed by a B, where price moves up. And at this point, the market is thinking, we're going to go up again. We're going to make a new high. I'm going long. But that's the bull trap, the B bull trap, because we've already done a nice 5-wave move down here. And this is a 3-wave correction up. It's again the 8-wave market cycle. Once we have 5 waves and 3 waves, we're expecting another move down. Okay, and we have it. Like we had this move down, and this is the first time in this whole move down. I can tell you that with confidence, it's the first time that this gray dot appeared. The signal for the breakout 4 appeared. It did not appear here. It did not appear here. This is the first time that it appeared, and this would be the ready. Okay, but we didn't scan for the ready, we scanned for the signal, and we get the green arrow, which is because price closes over the 12 EMA. So that's just sort of an arbitrary way of making sure we don't get in too early. But what I like to do on the weekly is I'll scan for the ready, and then I will look at the smaller time frames, and I'm going to show you that. But first, these green hatch marks, these are the profit target levels based on this price minus this price, and you can set this however you want. They're pretty, it's looking for another high, but I would probably, you can set them however you want. If we look at the daily chart, actually let's look at the 4-hour chart, the one on the right. So where you see this purple dot, you can't see it, but that's where the ready came in, and then you would look to take the trade once we take out these highs. This is like a 1, 2, 3 reversal. So this is really on this blue candle, this is where you would get in. And this would be an early entry, okay? Because didn't even trigger yet. It triggered once we went above the 12 EMA on the weekly chart. So this would be an early entry. So this is what we sometimes do if we if we scan not for the signal, but scan for when it first appears, the gray dot. But we don't want to just get in. We need confirmation. You could also get confirmation on the daily chart once these tops are taken out. Okay. And the first price target on the 4-hour is the tunnel. And then if we continue to move higher, we move to the daily. That'll be the next price target. That'll be the tunnel on the daily, which will be into the wave on the weekly. So that's the first example. The second example is Wells Fargo and Company. So again, here, sort of a different kind of a pattern, but nonetheless, breakout for trade with this gray dot. And once again, if we move to the 4-hour, it would be the purple dot, and then you would get in maybe just above the wave, because this is where the top of these candles are, right here. And your first target is here. Okay. Next example is Johnson and Johnson. Well, this was a very quick move up. So it gave the right here with the gray dot. It said, this is ready to go. And then you look at the 4-hour chart, and you would have gotten in right here. Okay. Right here, once we started to move above these highs. This is a 1, 2, 3 reversal, purple, blue, blue. Once we take out this blue dot, that's also taking out the highs when we move into this gap between the wave and the tunnel. Okay, so that was a nice trade, but you have to, that's why by scanning on the weekly and looking for these when they first pop up, you would go down to the smaller time frame to take the trade. And this is another example, also one of the top ones on the chart, but it's too late right now for this. I just wanted to show you the 8-wave market cycle, the setup, and these show up all the time. This is just gorgeous, where we have the gray dot, we have the A, the B, and the C down, and well, you see what happened. And looking at the 4-hour, the entry would be here. But look, this is interesting because this is an example where the wave has crossed back above the tunnel. So on the 4-hour, so this, once you have the signal, I mean, this is buyable on every single dip into this wave. It's buyable on every single dip. And now the market is stretched. Like now the market is stretched, so you have to wait for a pullback. But this is in a current uptrend now. So we need to wait for pullbacks. We're stretched. So now I want to show you some trade management, a trade management strategy. Trade management strategies, there are a number of them. The one is getting in and out all at once. So that's if you take one position and you get in and out all at once. And the second is getting in all at once and taking profits at various levels. That is the 3 profiteers, and that's the one that I developed. I'm going to show you that one, number 2, because it was meant for perfectionists. I considered myself a perfectionist, because when I would get into a position and I would take my profits too soon, I would be annoyed that I didn't capture, every last drop of the move. Or when the market would move up, if I were long, and I wouldn't take my profits, and then the market would come down, and I would give up all my profits, I would get really annoyed at myself. So really, I developed the 3 profiteers to take advantage of the moves and get out at various levels. But the third trade management strategy is to get into the position at various levels and get out all at once. And the fourth is getting in and out at various levels. So I'm going to show you number 2. That's what I do. That's what I feel most comfortable with. And strategies 1 to 4 go from simple to more complex. And which strategy you choose is a function of the trader's experience. And I know that there are some traders over the years who have said to me, well, why do you get in all at once and get out at various levels? Why don't you keep adding to your positions as it's going your way? Well, you can, but that's not what I do. Okay. So what is the 3 profiteers? It's good for maintaining balance on the fear and greed continuum. And that's what we want to do. We want to be balanced. It's perfect for perfectionists like me, but I've gotten a lot better, who want to capture every last pip, or in Forex, that's a pip, or dollar in the move. Okay. I'm showing you a pip example actually, but with stocks, you use dollars instead. So this is how it goes. It's based on the Fibonacci sequence. You determine the potential profit area. Okay, so assume the potential profit area is 100 pips, or let's say with stocks, if it's $10, let's say. Okay, the potential profit area, where you think it's going to go. So if it's a fill the gap trade, that's your potential profit area to the tunnel. And then you use the Fibonacci sequence. This is the sequence: 8, 13, 21, 34, 55, 89, and 144, and pick 3 profit targets, the third ending at your potential profit area. So you work backwards from the 100 pip PPA, and I'm going to show you this in example, with the Fibonacci sequence to determine your profit objectives. It just keeps it simple. So you leave your profit at 34, 55, and 89, okay? For profits P1, P2, and P3. That's that. In that way, you can literally put your levels in your trading platform. Then you set your stop loss at the first profit target, which is 34 pips in this example, and move your stop to break even once the first profit target is met. Now, this was the original set of rules, but I should add a caveat. You want to make sure that your stop loss is a valid stop loss. Okay, it might be a little bit more than that. You have to look at it yourself. And then if you can calculate your risk reward by adding up the 3 different profits, if you make all 3, and if you're risking 34 pips and you're making 59 pips on average, then your risk reward is 1.74. So, I mean, that's okay. And with stocks, you would do the same thing, only with dollars. Now, here is the example. The sell is here. So here we were talking about the purple arrow at the top, looking for the gray arrow at the bottom. In this is an hourly chart. So the market moves down. This is an impulsive move down, and then it corrects up in three waves. So let's just say that you sell here on a smaller time frame. You would be able to sell there, maybe not on this time frame. And your target is down here. So what's your PPA? Your PPA is 150 pips, because that's the difference between this price and what your target is. So I just use this as an example. Maybe your target would be more the tunnel, but I know with this that price usually goes below the tunnel. So you're setting 150 pip target, and then you work backwards and you get 144, 89, and 55 pips. And that's it. So you set your profit targets that way. And if you capture the whole move, great. If you capture 1 or 2, that's great. You're moving your stops so that you don't lose. You're always protecting your profits. So that's the 3 profiteers. Try it out if you like it. Use the Fibonacci sequence and determine your profit targets beforehand and work backwards. Okay. I think I'm just going to look to see if we have any. Okay. Right. All right. Yeah. I was just looking at the chat box to see if anybody was. I didn't have it up in front of me. Yeah, okay. Um so that's the three profiteers. Now I really like to get in all at once and then take profits along the way because it just helps with my balance. Just helps with it. Like I know I'm taking profits along the way, so I'm happy. And then, if I still have something left and it goes further, I'm happy. I'm not beating myself up. Okay. Let me just give you some trading tips before we conclude. Being organized can help you take your trading to the next level. It's really important. So, if you have a calendar and you fill it out on Saturday or Sunday for the week, actually put in your trading times that you're going to be trading. That's really important to do. I tell all my coaching clients to do that. And I know that I'm going to do that as well. I'm going to have my trading times during the week. And the next thing is, do you have a checklist for high probability trades? So, depending on what your strategy is, write down your rules. That's what your checklist is. Write down your rules and make sure you follow your rules. I know in our program, we have a checklist for every single trade we have 6 wavy tunnel trades, 6 trade plans. So, we have 4 trend trades and 2 end of trend trades, 6 trade plans. And you don't necessarily have to follow, you're not taking every kind of trade. You're focusing on one or two that you like and you're doing it. And once in a trade, do you manage it well? That is so important. Oh my gosh. And that's where the three profiteers comes in. We didn't talk about risk management. That goes without saying. You have to know what your risk is before you enter the trade. So you know exactly what you're going to lose and make sure you keep your stop losses in. You can always get in again. Like that's so many coaching of my coaching clients say, well, one thing that I do is I move my stop. Right. I know it's easy to do. Well, don't move your stop. Try it, see what happens. I guarantee you the one time you move your stop, it's going to be the wrong time. And that's the time that the market is really going to take you out and you're going to have a big, big, big loss. So don't move your stop. There's always another train to catch, right? Another bus to catch, another train to catch. There are stops along the way to get in if the trade is going your way. It's fine. It's fine. But we have to train our brain in order to be able to do that well. Do you take losses and move on, or do you add to a losing position? Right. So that's the same thing. Don't add to a losing position. Now, there is a strategy where you can say, okay, this market is in this range, and I am going to place buy orders at the low end of the range. You can do that. And so you might place 3 orders to 3 different positions to buy at 3 different levels. And yes, it's moving against you, but you have it in your plan and you have your stop loss as well. So that's a possibility. And then if the market moves up, you have your position at good levels, but you're planning on it. You're doing it on purpose. It's part of your trade plan. Do you keep track of your trades? That's really, really important. It's also important to have like maybe a trading buddy or somebody that you can speak to, because it's really easy. Trading can be a lonely business if you're not talking to anyone. So I know that if you can talk about your trades to like-minded traders, it's a really good thing, because then you can get it, whatever you've done off your chest, they'll understand. And you can also be accountable to the group or be accountable to your trading buddy. Do you learn from your mistakes, or do you do the same things over and over again, expecting different results? That's really a big one. Yeah, because isn't that the definition of insanity? Doing the same things over and over again, expecting different results. Yeah, we want to do things differently, and then we will get different results. So trading is a process, and we learn from this process and we make improvements from making mistakes. Everybody makes mistakes. That's okay. It's okay. We're not perfect. We're not perfect. So, getting started on your trading journey, we just reviewed a 3-step system: analysis, game plan, and trade management. And learning this will help you save time and effort, make more money, and achieve your full potential as a trader. And what I'm going to offer you today is FX Traders Edge presents Discover Your Trading Personality and get a free coaching session with me. And you can go to fxtradersedge.com/traders-scorecard. You can sign up here to take your trader's test. This is what it looks like. Take me to the test. Discover your new trading personality and maximize your success. So you take the trader's test, and then it will take you through to set up a time to meet with me, and we'll go through and we'll come out with an action plan for you to follow the first 3 top actions that you need to do over the next month to make some changes in your trading to begin moving from hobby trader to entrepreneurial trader, and begin moving from hobby house to transformational villas. Well, thanks for staying until the end. And if you have any questions, feel free to email me, Jody at fxtradersedge.com, and to take the test, do the trader's scorecard, and sign up for a one-on-one coaching session with me. This is the link, fxtradersedge.com/traders-scorecard. So thank you very much. And it was a real pleasure. Thank you, David. Thank you, Anka. Thank